I want to welcome everybody to our Bay Area Housing Market Town Hall. I just want to remind everybody, go to our YouTube channel. You're already on YouTube, then please do subscribe. We consistently trying to put out a lot of videos. Today, this is our 36th episode already. So hopefully you guys can continue to support us and subscribe to our channel. If you want to follow us and really continue to get more updates about our company, do go to our Facebook page, or you can go to our Instagram, LinkedIn, and TikTok. We have a lot of questions these days. And the biggest topic nowadays, inflation. Literally, as soon as I signed on, Daniel already talked about inflation. So how did it happen? And this is what I think about also during my leisure time. This is only from my own perspective. I just want to let everybody know this is from my own perspective. This is what I think has been happening. I always like to learn from others and also listen to other people, but I also want to come up with kind of my own theory as well and see if it really matches with some other people. So I don't know if you would agree with me or not, but now you can see my train of thoughts here. So in 2020, because of COVID, we obviously printed a lot of money. When you have a lot of money, money supply will increase. I think at that time, a lot of people already said that, hey, if we keep doing this, we're going to have inflation. But either way, at the time we have to give a lot of stimulus packages out. So definitely a lot of money being printed. And then also people have been saving so much cash in hand. Now, at that time, also they want to stimulate the economy. So they reduced the Fed rate to almost 0%. So that all of a sudden, we thought we are in this slump. And as soon as the market opens up a little bit, people start investing and buying because you can actually borrow at a super low mortgage rate. As example, and I mentioned it before, we have gotten a 2.25% 30 years fixed rate for our house. You've never heard of that. And I know right now, if those people who are getting over 6%, I'm sorry, but we bought it a long time ago. So we saw the opportunity that the mortgage rate has gone down. So we refinanced right away. And also because COVID, many countries had this, they shut down the manufacturing facilities, especially China. As you know, that we import a lot of products from China. So we had this like supply chain issues due to labor shortages and also manufacturers being shut down. So when you don't have a lot of products, obviously it drives up the cost as well. And on top of that, because of labor shortage, then what happens? Well, these companies still need to run their business and they are really trying to look for people to work for them. So now the wage increase. And then, of course, early this year, now we have a Ukraine war. With the Ukraine war with Russia, now we have this limited oil supply, and that has caused our gas prices gone up dramatically. I mean, we saw $7 per gallon here in California a couple of weeks ago. It had come down a little bit, but now it's definitely, $6 is very common here. And then on top of that, we have drought issue. The agriculture has an impact that has also caused some supply chain issues, which caused the food prices to go up. So all these factors really have led to this high inflation rates. With this high inflation rate, what does that mean? How come the Fed has been really trying to slow it down, but then it seems like the inflation rate is still not slowing down fast enough? Well, one of the reasons is because they can't really take back the money that they have already given to us or to the economy. And they can't really increase the supplies because most of our imports from China still has the zero COVID policy. So the market is still pretty shut down. And on top of that, the Ukraine-Russia war is still a big problem that's causing the oil price to go up. So this is one of the reasons why the inflation rate is still pretty high. It's taking longer than expected to come down. So the Fed's plan has been to fight this inflation as to increase the Fed rate. If they increase the Fed rate, they figure they increase the interest rate, then they will reduce all these investment incentives, right? That's why housing market, most people have, they do need a mortgage. Then less people want to buy, then the housing price is not going to go up as much. They increase the oil supply by releasing this strategic petroleum reserve, which is temporary. So that is how they are trying to control the gas prices to bring it down by opening up our own oil supply in the United States. But again, this reserve is just temporary. It's not going to be long lasting. So once they finish, I believe it's by end of this month, our gas prices probably will be going back up. And then another way is like they really need to increase the unemployment rate. So the wages would decrease. if they have the way to do that, right? You will have to instill some fear into the economy, into consumers, so that they are afraid to consume, so that the businesses can't make as much money in that sense, that they're not going to hire as many people. So then they will have more, hopefully increasing the unemployment rate. I just find this really interesting because compared to our last recession, the last recession was truly, it was like so uncontrollable that it just collapsed because of the mortgage crisis. But this time it's like a federal government inducing this recession, and they really trying so hard to tell people how scary this is. I'm not saying it's not going to be bad. I think it is going to be bad because this is the intention of really slowing down everything. But it's just kind of interesting how this recession comes about this time. Okay, so with all these thinking in my head, last week I actually went to Chicago and attended our CCIM annual governance meetings, and I had listened to two speakers. One speaker, he is, oh, sorry, let me show you some pictures. This is literally what we've been doing. I represented Northern California chapter, and we had pinned some of the new CCIM designees. If you guys want to learn about CCIM, this is like one of the hardest designation you can get in commercial real estate. Very exciting. They four new designees from California during this time, and they just took full 6 hours final exam before they were pinned. So it was really exciting to celebrate that moment with them. And then as you see, a lot of people were there. We had a lot of meetings and also conferences. And then it's such an honor for me to be working with like all these elite commercial real estate professionals from all over the country and also all over the world. So the person that I listened to first, it was Casey Conway. And Casey Conway, he's known for his really detailed economic updates, and he's the chief economist for CCI Institute. So after listening to him, I have to say I did feel pretty depressed because the economy, from what he's saying, it does not look good. I'm going to pull up just a couple slides for you guys to look at. So here we go. Number one, he said inflation has not peaked. By the way, this is like directly from his slide, so I'm just reading out from his slide. He said inflation has not peaked. It is still at 8.3% year over year for all items and 5.9% core, taking out food and energy, which both food and energy have increased quite dramatically. But the real household inflation rate is actually, it's called flexed by CPI, is over 25%. That sounds so scary. And then he said that food inflation is still rising, up another 10.9% year over year, and 1.3% in July for the food index part of CPI. Unfortunately, this is going to get worse because of the global wheat shortages and US drought impacting the Plain States wheat and corn yields and housing shortages. I think what crazy is that he said, and he's been right on a lot of things, he said the price for a loaf of bread will likely surpass the price for a gallon of gasoline by this fall. So I think, well, we're fall now. I don't really know how much it costs for a loaf of bread right now, but I thought this sounds a little bit scary, but I definitely can see the food prices is going to continue to go up because of the drought situation here. And energy index and gasoline prices dropped in July because of Biden release from the Strategic Petroleum Reserve. That's the reason why July CPI to come in flat. The energy index dropped 7.7% in July, and he's off a plus 11% increase in June. So this is interesting because I've been hearing a lot of people talking about this. And as you know, right before election, there are a lot of things that they try to implement, right? These policies to help with their election. So there you go. He said that October is right before the November elections. Maybe that's the reason why he was really trying hard to control the pricing. And the final inflation point is the wages. So the labor costs were up 10.8%. We still, as you remember, I think it was last month we did the employment rate, it was 3.5%. So we are still doing, the unemployment rate is still really low. So ideally, actually Federal Reserve, they are hoping to start seeing an employment rate to go up to about 5% in order for them to start easing on the Fed rate hike. People always say that, oh my God, next year we're going to be in recession. But if we're looking at the definition of recession, and we have mentioned in our previous episodes, recession happens when you have 2 consecutive quarters of negative GDP, which we already have. So technically, we are in recession already. It's not whether or not we will be in recession, we are already in recession, and how long that's going to last. I don't have an answer. I don't mean to ask this question as if I have an answer. I don't have an answer, but I'm here also trying to learn from other economists as well. All right, so the other person that I listened to, it was super interesting. This is the Gunnar, his name is Gunnar Branson. He's right here. It was right after our global real estate luncheon with other real estate professionals all over the world. I've met Siska, who's from Guam, and also Shinya-san and Ari-san, they're from Japan. And well, Larry, he is our chair for our International Activities Committee for CCIM, and he's in Seattle. So it was a really great event. And from here, he had shared with us a lot of how other countries are seeing US real estate. And so I mean, there's so many slides. I only, again, picked out only a few. Now, in terms of office vacancy, not only US, but pretty much globally, everybody has their office vacancy increase. So they really had changed quite a bit on how people go to work, not just in the United States, but all over the world. So although US has definitely increased more than the other, 18.9%, while Europe's only about 7.3%. But either way, is that the vacancy rate actually for Europe, if you compare to 2010, is still lower than 2010 Q2 of their vacancy rate. While US, we had already surpassed our last peak at 18.9%. And from their survey, this is also really interesting, is that 81% from their survey said that believe the pandemic has permanently altered culture and live work preferences. And 76% expressed optimism and planned net increase for investment into the US in 2022. This survey is from 1Q 2022. So I'm going to show you the difference in 3Q 2022. And then 71% planned investment increase into secondary US cities over the next 5 years. And at the time, most of the allocation, they were talking about Atlanta, Austin, Boston, and Dallas. And then the most popular sectors, commercial real estate sectors, are multifamily, industrial, life sciences, and storage. And it's pretty much similar across the board throughout the whole country, including California. And then the biggest concern that everybody has is the climate change, housing, and affordability. Now, 3Q 2022 now, 56% of the respondents believe that the industry was behind allocations for US real estate investments in 2022. They should have done more, and 80% communicated that the impact of inflation and rising interest rates was worse than expected. And that's why whenever our clients ask us, or anyone who asks us, what do you think about next year? We try to learn as much as possible from listening to different economists. And I try to do these monthly housing market update for you by doing a lot of research, putting together slides, and putting together a lot of stats. But at the same time, still, especially the mortgage rates projections, I still see a huge increase from just a couple months ago. And I'm going to show you at the end of this presentation. So what is the impact? So they actually look at US-based investors and non-US-based investors, meaning foreign investors, and how they look at it, right? There are 3 things that I want to point out. Geopolitically, conflicts in Europe and Asia will have increasing negative impact on global real estate investing. US-based investor, 69% of the US-based investor agree, and non-US-based investor, 91%. So in the world or in other countries, they actually believe that the geopolitical conflicts in Europe and Asia will have increased negative impact. But then US-based, only 69% of people agree that it's going to happen. And then when we talk about US economy, whether the US will enter recession within the next year, US-based investor, 92% of the people believe that we're going to go into recession next year. But only 67% of the foreign investors believe that we will enter recession within the next year. So that is a pretty big difference. It's 25% differences between US-based investor versus non-US-based investors. And then lastly is that any future US recession will be less severe than that experienced in the 1970s. That's 72% US-based investors agree, and 74% non-US-based investors agree, which is just very small differences. It is kind of important to note this, that Gunnar Branson had mentioned, is not that US is doing great, is because that the whole global economy is not doing that great. But in comparison, US market just seems to be doing better than theirs. So it's almost kind of like he used this really funny real estate analogy, is that you basically try to buy or invest in the best house on the worst block. So even though it is still a really bad house, but it's better than most of the houses over there. So this is kind of like how foreign investors are looking into the US market, although as you know, US currency have been really strong. So it's actually more expensive for the foreign investors to come in and buy US real estate or US products. There's a shift in expectations. The gateway cities will maintain their preferred status for real estate investment over the next 10 years. Actually, 61% of the surveys investor, they do agree. Gateway cities, San Francisco is considered one of the gateway cities. Secondary US cities will replace gateway cities for priority real estate investments. Earlier, we've mentioned that a lot of people think that they're going to be investing more in the secondary US cities. But now in this survey, it actually says that 51% of the people do not agree that secondary US cities will replace gateway cities for priority real estate investment over the next 10 years. So markets like New York, Boston, San Francisco, they are the gateway cities, and they're still maintaining that preferred status for foreign investors to invest. So what are the opportunities? There's limited amount of high quality real estate investments available in the US. So those that move first will have the opportunity to get invested. And then those with strong balance sheets will be able to lever up and act offensively during any market dislocation. I think this is kind of like, so we don't want to over leverage. We always want to have a strong balance sheet, even personally, not talking just a company, but even as ourselves personally, we should always have a very strong balance sheet, have some cash in hand instead of like using up all the cash in different type of investments. And then in terms of the threats, this is one thing I have been worried about, is that the major resetting of cap rates and erosions of value if interest rates stay higher for longer. So this is important because, as you know, commercial real estate is valued based on cap rates. If the cap rate goes up, the value comes down. So buying a property at a 4% cap rate versus buying a property at 7% cap rate, that can erode a lot of value from the property, especially for commercial real estate. Typically, you don't get a 30 years fixed rate. So you get about 5 years, 7 years, 10 years fixed, and then you're supposed to refinance, right? Or else your loan is due. So in that sense, that if your value has come down, you cannot refinance, that could be an issue. So that was all the slides from Gunnar Branson. And now in terms of like the IMF, they said that they do have a forecast for the global inflation, is that in 2022, the inflation rate is going to be 8.8%. 2023 is going to be a little bit better, 6.5%, and 2024, 4.1%. Again, this is the projections. As I mentioned, we see a lot of projections all the time, and they do change. But this is really good reference point as well, just so that you can really plan for your future, how to invest, and also how do you see the market. So my takeaway with all of this, I have 9 takeaways. So obviously, global slowdown is going to continue into 2023. US currency strengthens, which make it more expensive for the foreign investors to invest here in the United States. But because the US economy in comparison to the global economy is still considered the best house on the worst block right now. So we probably still see foreign investors coming in to invest. And US real estate investing will seem to be a good safe haven for foreign investors to preserve their wealth. And multifamily and residential properties will have the least impact compared to most other asset types. So we remember we just talked about food price increase. Well, do more home gardening. So that's what I've been thinking. It's like, I need to do more home gardening, although I don't know how to garden. Anything that I plant, they seem to die very easily. So I better learn how to do home gardening. Food prices will continue to increase due to the drought. So we should definitely prepare for that, and do invest in clean energy so we can be more independent from foreign oil. We will see more distressed properties in commercial real estate sector because the cap rate increase, property values will decrease, and that will be very difficult for property owners to refinance once their loan is due. And lastly is that, again, I do think that we are in recession already. It's not whether or not we will be in recession, we are already in recession. And if you want to hedge this inflation, I don't know if you know that, I was introduced to this and I was so excited. You can actually invest into the Treasury I bond. It's giving 9.62% right now. So it's only up to October 31st. You can open an account, just type up, I bonds, how to invest in I bond on YouTube. There's so many videos to teach you how to invest into I bonds. If you want to hedge some of your investments, go ahead and try this out. You can also buy some of these I bonds on behalf of your family members, but it's only, I think it's $10,000 max per person. But still, it's still really good investment if you cannot find anything that yield 9.62%. Thank you again for tuning in, and then don't forget to subscribe to our channel. If you have any real estate purchasing information or other information about home buying, please do contact us. Bye-bye.